Hi everyone, thanks for joining. We've got a few more people still coming in, so just give it one more minute, and then we'll get started. Okay, we're going to get started, everyone. So thanks for joining me. This is our Getting Paid webinar. This is one following on from the one we did last week around your business continuity plan. So there's some areas we touch on again for some of you that are on that as well, but this is taking it a step further and particularly focusing on money right now. So how you go about getting paid and improving the cash in your business. I'm sure you're all really familiar now. Everyone's using Zoom, but everyone's muted at the moment. We have the chat and the Q&A feature enabled at the bottom. So if you do have any questions or any comments or feedback, please put it in there as we go along. I'll try and take a look as we go, but we are going to have time for some questions at the end. So I will just ask if anyone can just send me a message now in chat, just to make sure that I'm not talking to myself and that you can all see the presentation as well, if you don't mind, please. Lovely, thank you. Okay, so right, in that case, we'll carry on then. So we've got some clients on the call today, some non-clients. So hello everyone. For those of you who don't know me, my name is Luke. I'm the CEO and founder of Crisp Accountancy. We are an accountancy firm who work with ambitious, growing businesses, and we have a focus on helping to provide information that helps you to make better informed business decisions, providing you clarity and confidence in the numbers that help make up your business. So that's what we're all about. There's my contact details for anyone that does want to get in touch afterwards. Yeah, okay, lovely. Sorry, just checking that everyone can hear me. Lovely, good. Okay, so we'll start with a thought as always. When a recession does materialize, many experts agree that ready cash is the oxygen that every small business owner requires to survive. Not just in the case of recession. We always talk about cash being the oxygen and the lifeblood of a small business, but obviously when times are tough like they are now, then cash is even more important. So there's a reason they refer to cash as being king. So today we're going to go through a few different things, and first of all, we're going to focus on the mindset. Cash, sales, asking for money, chasing debts, they're all dirty words right now. People are either afraid to talk about them, broach the subject, or they just don't know how. And some people are hiding away from them. So the first thing to do is to talk to you about the mindset that you need to get through this. The next thing is to make sure that you've got a debtor system that works for you. So not just a case of randomly firing off chase emails when you remember that someone owes you money, but having a systemized process in place is key. The lessons that you can take forward and the actions that you're going to take from those. We'll very briefly touch on the support that's available. I'm sure most of you by now hopefully already know, but again, if you've got any questions on that, we'll cover those. And then talking about what the steps and the plan of action you're going to take moving forward. So there's 3 different areas to the mindset that we're going to talk to you about today to get right before you even approach this subject. First one's around empathy, making sure you're empathetic. The way that you approach your debtor management system with backbone and heart, and the fact that it is okay to sell in these times if you can get things in the right place first of all. So remember the analogy of the oxygen mask in a time of emergency, i.e. you need to put it on yourself first. If your business falls over, no one's going to win. And that's important to get to remember that when you're thinking about what mindset you're going to be in when you approach talking about money. So it's not as simple as just saying, okay, oxygen mask on me, it's all about me, customer or client, you must pay, we're not going to help you. it, I've seen people doing that right now. That is definitely not the approach we're telling you to take. And I know, I'm sure that everyone on this call isn't already thinking in that way. And in fact, the majority of people we're talking to are thinking the opposite way, in that they're trying to show sympathy rather than empathy, and they're hiding away from the fact they need to address this. So it does still need to be addressed, but with empathy. So settling in and providing a framework around how you deal with empathy with credit control is really key for your own sake. If you're the person chasing the debts, which we probably don't advise, we'll cover that later on, but for anyone else as well, so everyone's taking the same sort of structure to that. So remembering that it is another human on the phone at the end, ask them how they're doing, talk to them about how their business is doing, and then you do need to consider your options. So yes, you need to chase the debt, but they might be a really loyal client. You might genuinely know that they're very much in trouble, and you might decide to extend terms, for example, if you really think that's the right thing to do. I'm not saying that it's not, but you need to make a sort of a decision. You don't need to let the client be defaulting and extending their terms by default. It needs to be a situation that you control. And then talk to them about the options that they have to pay you, and make sure that they understand. So empathy is the key thing to get right here. If you don't show empathy at this, you've got two options. You either don't do credit control, in which case you're going to run out of cash, your business is going to fail, your clients are going to suffer, you'll suffer, your family will suffer, etc. Or you chase too hard and you don't show any empathy. And yes, you might get more money in now, but it's going to harm your reputation and your business in the long run. So there's a fine balancing act here, and empathy plays a key role in that. It's key to have both backbone and heart, and this can be troublesome for some people. So a lot of people are having heart at the moment, so they're trying to do everything they can to help other businesses, and heart might look like, on its own, might look like, well, we know they're struggling as well, so we'll let them have loads of time to pay, or they can just pay when they're ready. An element of that needs to be in there, so you do need to be flexible and mix up your approach depending on their circumstances. Consider other options to get money in that you might not previously considered, but you have to have backbone as well. So you have to have a certain element of being firm in there and making sure that you are paid for the value that you're providing to your clients. You're running a business as well. You have people that rely on you, like I just said, your team, your clients, your family, your own sake. You've worked really hard to get this business where it is. You've got to put that front and foremost at your mind to be able to remember how to approach this subject. So it's backbone with heart is the key here to move forward. And the other thing that I found, especially on LinkedIn, I've seen loads of, and it's people moaning about people selling in this situation. Everyone has a slightly different approach to this, but if people stop selling, the economy and therefore the country will grind to a halt. All the hard work we're doing will be for nothing. You absolutely have to continue to sell right now. There's just a certain way to do it. Nobody wants anyone to be product pushing or overselling or any questionable sales techniques to convince people to sell. That's not what we're suggesting. That definitely is not okay right now. But if you are genuinely providing a solution to a problem that a client has, or you're providing great value to them, then that is what you should be doing, and that's what you should be continuing to do. So this is particularly relevant for for our service-based businesses on the call, and that is this spin cycle or technique from a sales strategy. It's been around since 1988. I actually learned it a long time ago, and it does really, really help if you're a service-based business. So it starts with this. So it starts with the S, which is the situation. So the key to this is all about asking the right questions. So the first question is all around find out about the situation. So you might be asking how they're coping at the moment. Are you spending a lot of time on video calls? Are you still getting clients coming in terms of revenue coming in, that sort of thing? So find out what their situation is. then start to recognize the problems, the underlying problems that are inherent in the situation that they've talked about. So, so a problem question, for example, how do you feel every day? Most probably is starting to feel like a bad hair day. Um, if the situation is we're running out of cash, what is the problem there? Yes, running out of cash is a problem, but what are the underlying problems there? So it might be that they've got no system in place for controlling their debts. It might be that their debt days is too long. The terms they're giving the clients are too long. Once you've identified the key underlying issues, and it can be quite tricky because sometimes the problems that present themselves aren't the underlying ones, then you need to identify and discuss and talk to your client about the impact or the implications that will happen if these problems aren't solved. So this is the negative flow on from that. So if a problem is that you're running out of cash, the subject that we're on at the moment, the impact will be that we can't afford to pay staff at the end of the month, etc., etc. And then the final step, once you identify those, is to present a solution that solves their problem. So what are the next steps? So in this situation here, when we're talking about this, if this was a client coming to us, we understand they're running out of cash, their debt days is a problem, the underlying problem is that they don't have a system in place. The next steps might be to help produce a systemized approach to collecting debt, for example. So this is a really, really great way to be thinking about selling now if you're providing a service. And like I said, it is absolutely okay to be doing, and you need to carry on selling. There's just a certain way to go about doing this. If you're solving genuine problems, great. If you are overselling, taking advantage of the situation, any of those things, that is not okay. You're not going to do yourself any justice in the long run. So we talked about the mindsets that you need to be able to start addressing debt, essentially, and getting some money coming in. So now we need to start talking about best practices to manage a debtor system. Talking about the guides that we've got that we're going to show you in the scripts, and what credit control services look like from an outsourced provider. So essentially, nothing should really change. You should ideally have this in place already. It's just embedding the empathy that we've talked about at the beginning here into your practices already. Now, I do totally appreciate that not everyone will have this set up. So if you don't, then fine, just start from scratch. That's not a problem. But if you do, it's just tweaking the way that you're going about this in the first instance. That's really, really key. So I'm sure the sort of people we've got on the call today, I'm sure nearly all of you are dealing with paperless already. We have for a long time. I know a lot of our clients have for a long time. If you're not already, obviously, virtually no one is at their business premises right now. If you're sending statement chases and invoices out by paper, you're on to a lose-lose situation straight away. Then you're not going to get paid. So if that is you, it's very easy to address. Any of the cloud-based software providers have this built in, a very seamless process. Use it straight away if you're not already. The way to treat your credit control is to treat it like any other aspect of your business. So if you take the operations side of your business, i.e. producing your goods or selling your services, most of you already have things like templates, flow charts about how the service works, procedures, processes, all of that kind of thing. And you need the same discipline to be applied now to your credit control process. So the very first thing that we like to do is just draw out for a flow chart what it looks like, all the way through from when you first engage a client through to when you finally do get paid, and perhaps even after that. And there'll be various different stages to identify the key in this. It's just some milestones. So the milestones might be when you make the first sale, when you send the first invoice going out, when they miss the deadline for the first time. And then you might have a process of an email going out on 7 days, 14 days, 21 days. And then you need some sort of escalation process as well. So what happens if they haven't already paid you during that initial sort of phase where they become slightly overdue? So you've got up to the point where the debt becomes due. You then got an initial phase after that, which is normally automated, and then you then got some sort of escalation. So mapping out that flow chart is the first thing you need to do. The next thing to do is to decide where the contact points are. So these are likely to be either email or phone. Like I said, we're not really going to use letter. You can automate the first stages of this very well with emails. So you can get some template emails produced, and you can speed that process up and make sure it's automatic. And then any of the calls you're doing, you should have scripts available. So they can be very basic. We've got some we're going to share with you, but make sure you've got scripts so that you're following the same sort of pattern and identifying and tweaking it and working out what produces the best results here. We've got credit checks for new customers, which we'll touch on in a minute, and then we got talking about outsourcing your credit management as well completely. So these are the sort of guides that we're going to share with you afterwards, so you can get an idea of what they look like. This will be a really good starting point. If you don't already have this, you can share these with your team or whoever is responsible for collecting the debt in your business, and you can start to really standardize the process. And this is going to help a lot. Particularly at the moment, if we go back to talking about building empathy into the framework of this, you can just tweak these call scripts just to include a bit of empathy in there. And you'll see this one here talks about the COVID-19 situation, etc. So we'll share these with you afterwards. Anyone that's on the call, you can download these and use them as you wish for free. It's important to remember that credit control is not just about following up your debtors, it's the complete system. So from when you take a client on all the way through to when they paid you, and perhaps even after they paid you, send an email to confirm they paid you, a receipt type email. That's essential. It really will free up your time. It's really, really common for business owners to think that it's just a job that they should be doing or that they could be doing, but it's really not a best use of your time. So outsourcing that, we find, is very helpful. It frees up your time. If you're outsourcing to a professional, they're going to be able to get better results than you, frankly. And also it helps to differentiate the relationship. So it's important to build a relationship with your provider, but sometimes it can be really awkward, the relationship you need to build as a sort of service provider or an account manager, if you like, to your clients, to then suddenly be talking about what can often be deemed a negative conversation around paying debts and the need for that backbone that we talked about where it's possible. So sometimes it's really hard for people to split that relationship with people. So that's why outsourcing it can work really well. It's essential that if you are going to outsource it, you do build that relationship with your provider so the outsourced credit control provider. And we're not just talking about what we talk about being an ambulance at the bottom of the cliff. So it's not, you can't just suddenly outsource the worst debt that people are really struggling and just outsource and expect someone to be able to pick this up and work miracles with this. Firstly, they're not going to be able to do much with it if it really is that bad a debt. And also, if your client is really struggling and you haven't gone through the process, you haven't shown empathy, and you just pass it off to a debt collector, that's going to ruin your relationship straight away. So yes, there is key here to outsourcing this, but doing it in the right way is the important bit. So like I said, we've got some content. If you're not going to go outsourced and provide it, there's lots of outsourced providers out there, then at least having a credit manager, so somebody that isn't you, that is responsible for this process and takes ownership over it, and share this with them. Those who have got an in-house bookkeeper, for example, they're a prime candidate to be able to do this as a first step. They normally have a slightly removed relationship for the client. They won't be the one dealing with the client on a day-to-day basis, and they should be well versed in talking about numbers and finances and not feel awkward having those sort of conversations. So these are the key sort of steps to go through and think about when you're deciding who's going to sort of control your credit control and what it's going to look like. The other thing that lots and lots of people or businesses we talk to don't do is credit checking their clients at the beginning when they work with them. If you're providing payment terms to somebody, you are effectively providing them credit, exactly the same as a loan or anything else like that. You're letting them pay in however many days. So checking their credit worthiness is key to that. So there's two providers there, Equifax and Endol. There's plenty of others around, pretty easy, pretty cheap to sign up to do that. You need to be embedding that into your client onboarding process. Whilst it is important, obviously it doesn't show you the whole picture. With the situation changing so rapidly for so many businesses at the moment, don't rely solely on that and think, okay, the credit check said they're fine, we're going to go and give them 300 grand's worth of credit instantly. It's a part of the puzzle here, it's not the whole solution. So now we want to talk to you about the lessons and the learning that you can take moving forwards to be able to take some action off the back of this. So there's effectively 6 steps you should be taking now or looking at taking. And for those of you on the business continuity planning webinar with me or have watched that back, a couple of these are familiar to you. We've covered them here. People haven't seen them, and also they are so key. And you might see them in a different light now in the context of improving the speed that you get paid from everyone. So we're going to talk about the cash conversion cycle, how to track it, what it means, and how to improve it. Your business 101 cycle, so the cycle from which you turn cash, profit into cash and go round and round and round. What are the individual causes of poor cash flow and how can we look to address them? What you can do to get some runs on the board quickly, and then just briefly spend a little bit of time talking about what assistance you might be able to get from the bank and the government support and tax considerations, etc. So this is what a cash conversion cycle might look like for a business that has stock holding. So for example, over here, day 0, you might buy the stock from your supplier. They have 45 payment day terms. So in 45 days, you're going to be paying that supplier for the stock that you've got sitting there in your warehouse. That's the cash going out. On day 60, you sell that stock to the customer. So your average stock holding is 60 days. You brought it here, you paid for it on day 45, and you effectively sold it on day 60. You then have a 60-day payment terms, or you don't have payment terms 60 days, but that's how long you're taking for your clients on average to pay you. So in total, from when you buy that stock all the way through to when you get paid, that's 120 days. But in there, you've got cash going out on 45 days. So your cash conversion cycle is 60 days, average stock holding, plus 60 days, your average receivables or your debtor days, minus 45 days, which is your payment going out. So that gives you an average cash conversion cycle of 75 days. For those of you that don't have stock, if we just change the titles around here, this same principle applies to you. And if you're selling services, then what this period here, this 60 days is, this is your work in progress. So this is where you have jobs that you haven't finished off, or maybe even worse, that you've finished off, but you haven't yet emailed the client about, invoiced the client. So I spoke to a client just a few hours ago, and he was explaining how busy he is. He's very lucky in that he can still carry on working, which is great for him. But one of his issues right now was he's really busy, his cash is starting to become a problem, and one of the main problems is that he's not invoicing the jobs quick enough after he's finished them. So he's finishing jobs, moving on to the next one, and not invoicing them. So one of the key stats that we always track when we work with clients is this here. So your average receivables, 60 days, your debtor days. It's really easy to track that. And it's really easy to decide whether that's okay, whether you're happy with that, whether it needs to be improved on or not. But often the hidden one is your stock holding here, or if you're a service-based business, your work in progress, because it's not as easy to track. And it could be that you're keeping onto an invoice, you're not sending out for 30 days, and then you're looking at your debtor days over here of 60 days and saying, okay, I'm fairly happy with 60 days, but actually it's 60 plus 30, so it's 90 days. So watch for that hidden element there. You'll be amazed when you start to do this and you start to understand the power of reducing down your debtor days and speeding this up, what the implication is onto your cash. So you're not selling anymore, you're not making any more profit. All you're doing is tightening your procedures, and by doing that, it will result in extra cash in your bank. So for example, if your debtors, so the amount you're owed is £50,000, your turnover is £500,000, so 500,000. If you were to reduce your cash conversion cycle by just 10 days, that's going to put an extra £13,700 into your bank account. And that's just 10 days. So some of you might already have this as a very tight process, and you might only be able to tweak it and get it down by a couple of days. Well done. That's an amazing thing anyway. Your impact will be smaller, but if you've got larger turnover, obviously it'll be amplified. But for those of you with debtor days of 30 or 60, for example, then there's huge improvement to be made here by putting these processes in place that can make drastic reduction in your debtor days, and it can put some serious cash into your bank account. So you need to be addressing this. You need to be tracking this if you're not already. You need to be looking at the action you're taking and monitoring the impact it's having and tweaking the process to keep improving that. So the other sort of mindset or sort of process to really understand is the business 101 cycle. So this is all about the speed it's taking to turn profit into cash and increasing your return on investment. So you start over here with your business, your owner, they'll normally invest in the business at the start, and they'll use that money to buy assets. They might get other money coming in through loans or overdrafts or investors or whatever else it is, but they're using that money to buy assets. The assets are used to generate income, which obviously gives you profit. So at this stage over here, you can have drains and gains in your profit. So yes, if you need to increase your profit, we can look at things like, what's your sales doing? How can we improve your sales? What's your margin like? So what's your profit margins, net and gross profit margins? How can we get more profit out of the sales that you're generating? If you're not keeping your expenses in control, you can start to lose and drain profit at this stage here. But presuming you're doing everything you can to make profit, next step is to turn that into cash. So this is what we've just been talking about here. Even if you're making good profit, you can still be draining cash. So if you're slow to collect your debtors, the profit kind of becomes irrelevant if you're not collecting that cash in. If you've got a large stock or work in progress days that we just talked about there, then that's quite often a hidden drain on your cash that you're not even aware about. Financing, repaying loans, that can be one of the most expensive cash drains you have on the business. Can you refinance them or change them up and pay more tax than you need to? So obviously the opposite of that, the gain here is improving this speed, collecting your money in faster and becoming as lean as possible. So maximizing your payment of suppliers, as long as you're within their payment terms, obviously, and really trying to decrease that stock if you have stock, or work in progress if you're a service-based business. That will then give money back to the owners. The owners then have a decision to make. You either, or part of it will be used to fund their personal lifestyle, drawing it out in dividends, loan repayments, salary, etc. And whatever's left will go back into the assets and go round again. And the key to this, to really get the biggest return on investment, is to speed this cycle up as quickly as possible. At this stage over here as owners, the more money you can be putting back into the business and invest again, then the more profit it will generate, the more cash it will generate in return, and so on and so on. So this decision up here, all of a sudden, is very, very key. If you can get your personal expenses down and leave a bit more money in the business to invest, then you're probably going to be much better off in the long run. So these are really the only impacts that you have on cash flows. So we covered some of them off already. So the most obvious one when anyone looks at their cash flow is their accounts receivable process, so your debtor days. How long it's taken you to get paid from when you issue an invoice versus what your payment terms are. So the quicker you can speed that process up and get money coming in quicker, and get those debtor days down, then obviously that's going to massively help increase your cash flow. The accounts payable process. So this is how quickly you are paying out your suppliers. And it might seem like a strange situation to be talking about this, but we've seen this happen time and time again. The first part of this is to negotiate better payable terms for your suppliers. So talk to them, communicate with them, make sure you're maximizing the payment terms that you can get out of them, whilst obviously still maintaining a fair relationship and keeping that balance there. And then making sure that you max out that accounts payable process if you are struggling for cash flow. There is absolutely nothing wrong. In fact, it's a great thing to do. If you are in a positive position for cash flow and you can afford to help others out and pay a bit sooner, then great. I'm not saying don't do that. But this is for people that are struggling with cash flow themselves. If you're struggling with cash flow yourself, remember you need to put the oxygen mask on yourself first. You need to look after yourself before others. And we are seeing people who are really struggling themselves, um, showing sympathy and trying to help others out and paying their suppliers earlier than they need to. And that's just causing more problems for themselves. So yes, you can do that once you get your own cash flow in check, but not before. So your whole inventory work in progress process, we've just been talking about that. Getting that down and lean as possible is key. And even tracking it is a really good first step. So a lot of people won't even be tracking that. So if you can, start to think about it. If you've got stock, it's far easier to work out what your inventory days are. It's pretty easy to do with help from an accountant or somebody who knows how to work that out. The whole work in progress thing, like I said, is much trickier. It can often be a silent or hidden cost. So you'll need reporting around your services and your operational side of the business to be able to look at what work you've got coming up that you committed to doing, what work you're doing but haven't signed off, what work you've signed off and delivered but you haven't invoiced. So they're the different stages that you need to be looking at and tracking and trying to get that down as lean as possible. So to give you an example, if you were to come to us, we don't do this with many clients anymore, but if you were to come to us and just ask for a set of accounts at the end of the year, and we said, yeah, great, that'll be £1,000, we'll get started on them now. We then get busy. We then don't do them. The client's not bothered about receiving them for the next 6 months. They said, take your time, it's fine. We can't invoice until we've completed those accounts and sent them to you. And we're then sitting on work in progress. So we're letting those build up while we concentrate on other jobs. That means we have a cost sitting there that's not efficient and it's costing us money in terms of cash. We could get access to that cash if we can finish the job, speed it up, invoice straight away, and then concentrate on collecting the money in. Another one that people might understand is an inappropriate debt or capital structure. For those who've got loans and stuff in place, they can cost you a lot of money, the interest repayments, if they're substantial, and making sure you understand what debt's outstanding, whether you can refinance those and service the business debt in a more efficient way to lower your repayments or to lower the interest you're doing, paying out there is a great way to improve not only cash flow, but your profit as well. Obvious one, overheads too high. If your outgoings are too high, it's going to hurt your cash flow. So make sure you get a good grip on those, really important. So your gross profit margin being too low. So your gross profit margin is your sales minus all your costs that are related to providing those services or those products. If you're a product-based business, it is your cost minus your stock and some wages in there. If you're a service-based business, it will be your sales minus the cost of your staff that are working directly for the clients. So you wouldn't include marketing staff or director staff or anything like that. So the first thing to do is identifying what your gross profit margin is. What that tells you is for every sale, so if you have a 50% gross profit margin, for every sale that you make, 50% of that will be swallowed up instantly in your cost of sales. The remaining 50% can be used to pay your overheads, so make sure they're not too high, and then whatever's left is going to pay out your profits. So your overheads, once you've got them as low as you can, they're going to stay the same mostly. So the only way to improve your profit and therefore your cash afterwards is to make sure you've got a good grip on your margins and you're making a good healthy margin. And then the other one, just which obviously a lot of people are struggling with right now, which is why we talked about spin selling at the beginning, which is, yeah, you might have all of these in check, but if your sales are too low, then obviously you're going to be harming your cash flow. So go back to the beginning where we talked about what is okay to do in this time and what is not, and reminding yourself that that sales is not a dirty word right now. It can be done to the benefit of you and your business, but also to the benefit of the client. If you can't get that mindset right, you're going to really struggle to come out of this situation. So please spend some time thinking about that. And a great tip for doing this, if you are really struggling with that, firstly, you're too nice. But so a way that you can get around that is list all the people that are dependent on your business surviving. So it might be a spouse, children if you've got any, maybe friends and family. If you rent your house or you rent your office, the landlord relies on you. If you've got suppliers, they rely on you paying them, your clients, all the rest of it. List out every single person, directly or indirectly, that would be out of pocket or struggling if your business was to fail, and look at that list. That will help you get your mindset right and concentrate on sales coming in. Just seeing what's coming in the chat quickly. So we've got a quick question I'm going to address now. So, do you have a suggestion for a healthy gross profit margin we should aim for, and possibly a bare minimum? I don't, Wayne. It really, really does vary completely depending on every industry. Then within every industry, it's every business, and even within every business, you will likely have different profit margins. Whether you can see them or not, they might be there. So, for example, if you are selling and installing products, then you'll have a gross profit margin around in your business as a whole, but that won't tell you too much. What you then need to do is look at your gross profit margin of the products that you're selling, and then look at the gross margin of the sale of the install that you're providing as well. So the key here to managing your gross profit margin is to start to look at the different segments of your business and start to try and work out what your gross profit margin is. The answer to a healthy gross profit margin is whatever can pay off your overheads and give you a healthy net profit. So that's why it's determined by your business model. You need to answer that question fully. What you need to do is you need to work out what your business model looks like. That can be very complex, or you can do it really simply, back of fag packet type calculation. So get a good idea of your overheads. So they're the costs that remain the same and are stable. Get an idea of what sort of profit you need as a minimum, or your target profit. Add that back on. That'll give you an idea of your gross profit. And then you can start to look at what sales you've got coming in and what margin you would need to achieve on realistic sales to be able to provide that. So that's a business model in its most simplistic format. So what you should be focusing on right now is getting some runs on the board quickly. You need to pull everything we've spoken about together, and obviously when times are tough like they are now, crisis management, all the rest of it, getting runs on the board as quickly as you can is the key to surviving. So there's some things you want to do here longer term, but some things that you can do instantly, really. So outsource credit management where you can. So like we said already, be careful of suddenly enlisting the services of a credit controller or a debt collector with customers you know that are struggling. You're just going to make the relationship worse. So it needs to be done subtly or tactfully, or for the right clients even, potentially. If you don't already use an outsourced credit controller, then look at who you might be able to get in-house to do this. And we still recommend you implement that as a longer run. Your accountant might be able to help you. We do that for some clients as well. In either case, you're most likely going to need to deal directly with the customer who can't pay you. So those real problem ones, you're going to have to address and deal with, frankly. The rest of the situation, and in the longer run, great, outsource it or deal with it that way. Looking at and revising potentially your terms of trade or your proposals or your terms and conditions, whatever, and making sure that you're not perpetuating these poor practices that are probably built into your business in the future. So when we look at short-term fixes, i.e. speeding up trying to collect debt, there might be some inherent issues in there. There might be around as far back as when you onboard a client. So how you onboard a client and talk to them at the point of sale around setting expectations, setting payment terms, all the rest of it. That's really, really key. So if you're a service-based business with repeating income, like we are, and our clients will know this through on the call, we have a very good process, like you would imagine we do, hopefully. Otherwise, we're not really qualified to talk. But for example, our services, we will invoice on the first of the month. It will be automatic. It will go out. There'll be already a direct debit set up, and it will collect the fees for that month ahead. So we're massively speeding up our whole billing process, and we're making it really, really efficient. So your billing process is key there. So I just touched on that a little bit as well. So if we just take the scenario there that we just talked about there, some accountants will bill you at the end of the month. So say the 30th of April, they might then issue an invoice for that, and you might take another 15 days to get paid. So they might say their debtor days is 15 days, which is normally okay. That might be okay. But for us, we invoice on the 1st of April. So if our debtor days are 15 days, we get paid on the 15th of April, not the 15th of May. So actually, in that scenario, our debtor days are a whole 30 days, a whole month quicker than the other accountant, because our billing process is geared up that way. So making sure your billing process is geared up, and the automation is the key part to this. It is not complicated automation. If you are using things like Xero, Xero's our specialism. I'm almost certain the others do it as well, but we'll talk about Xero. You can set up template emails that go out X number of days after the debt hasn't been paid. So automating that, having a series of emails, each slightly more escalating the process. So you might have one 7 days, 14 days, 21 days, etc. Automating that in there is really, really key. And then there's another step beyond that, where there's other software that you can really get far more detailed with, customize the situation, make it more personal, etc. So that can help. But as a basic, you can turn on the basic automation very, very easily here. It's not a big ask. And then the other step, particularly if you're a bigger business, but is around the management controls and the procedures. And this is particularly controlling your outgoings. So who has authority to spend in your business? What does that authority look like? Who can order stock, and how much can they order, etc. So these are questions that you should be revisiting and asking yourself, is that causing some of our credit control issues? So there's quick fixes, there's things that we can do to identify and try and speed up the collection of debt, but there's also some underlying inherent issues in businesses normally that have cash flow issues. So they're normally far harder to understand, but some of those bits will help you there. Okay, so we'll go to the next slide. So we talked about the cost of debt structuring and getting that wrong, and it can be very, very costly to you. So if you have funding in place, and that can take many different forms. It could be an overdraft, it could be a standard term loan, it could be a invoice finance and asset financing, any of those sort of things. You need to be constantly reviewing them and making sure that that's best for your profit. So you're lowering the interest as much as you can. And then also, when times are tough, focusing on the cash flow element of it. So it might be in the short term, you might be okay with paying a bit more interest if it helps your cash flow. So if the repayments are less, or you stagger them, etc. So first port of call normally should be the bank, but there are plenty of other providers out there now that will help with this stuff. So looking at your overdraft, is it still right for you to have an overdraft? If you're always in your overdraft, that's not a best use, and that's a very expensive loan funding process. So it might be you should come out of your overdraft and go into something a bit more long term to fund that. If you've got assets around, so property or equipment that's worth money, you can leverage that to finance the business in tough times. Revisiting any of your existing loans that are in place, asking for loan repayment holidays, deferment, extension of lending periods, those sort of things are really, really key right now. And then it might be that you only need a very short burst. So things like credit cards might be a good option for you. Always be careful. The interest obviously can sting you in the long run, but you might be able to sign up some pretty attractive credit cards that might be the way to go through this period. There's no right or wrong answer to this. Analysing your whole cash flow cycle is key to working out what's best to help you fund through these times. Like we said, I'm sure most of you know this by now, understanding what support's available to you is absolutely key. So we just whiz through a couple of these. If you've got any questions, fire them into chat now, we'll talk about them. Deferral of VAT, so any VAT that from sort of mid-March, I think it was, can't remember the exact date now, but up to the end of June that was due, you can automatically defer. You don't need to apply for that. You do need to cancel your direct debit with HMRC if you have one. It will be due by the end of March 21. So please don't forget to make sure you factor in how to repay that. There's all sorts of changes to working tax credits and universal credits for those directors that are struggling, that are pretty much under supported by a lot of this. I'm sure I might have absolutely had enough of the word now, but I'm sure you've all heard enough about the furlough scheme for workers that aren't working right now, 80% of pay. Those claims, that claim system is open now. If you have furloughed workers and you haven't made a claim or your accountant hasn't, get on it right away. 6 days payment delay at the moment, so it's pretty quick getting in. We've seen some clients have had money in today, so from that, so that's working. There's some business rate holidays and grants depending on what sector you're in, particularly if you're retail, leisure, hospitality, or if you're qualified for small business rate relief, there's grants available as well. And again, all of those should have been actioned and paid by now. So if you think you qualified for those and haven't got that, now's the time to take action. The difference that we're talking about this now is when we mentioned it previously, it was this is what's coming up. Now this is, you should have had this, or you should be getting this. If you haven't, question it. And then the other thing that's available is, we talked on the last slide about ways to fund your business. The Coronavirus Business Interruption Loan Scheme, CBILS, is the government-backed scheme, 12 months, 0% interest. After that, typically 3 to 5% interest. No personal guarantee below 250,000. Lots of conditions, lots of hoops to jump through. But if you need it and you can benefit from it, that might be a very good way to fund your business at the moment. These are what we're talking about, understanding your options, making sure that it's best for your cash flow, not just because you've got an existing loan in place, you're not going to think about that. You can still look at that, and your accountant should be able to help you with that process as well. So we're going to talk about your next steps. So hopefully for you, doing nothing is not an option. Virtually all businesses are either struggling or considering their cash flow at the moment. Please don't just bury your head in the sand. It's not going to go away or make it much worse. You do need that backbone to go with your heart. So that is concentrating on putting your oxygen mask on yourself first, but remember to show empathy. Make a plan for what action you're going to take. So today we talked all about how to collect money in quicker and your cash flow. So you should have some action points to take away from this to go and put into place right now. If you haven't already, drop me an email and I can send you the link to the business continuity plan webinar we ran. That's a very a more broader, rounded plan that will help take you through all the different elements that you need to protect your business right now, cash flow being obviously a main part of that. Surround yourself with experts. So you take lots of advice, but only from the right people. There's lots of misinformation around at the moment, fake news. So yes, take lots of advice, but make sure that you're getting it from people that you trust. And the last point is something that I learned really well over the last 6 to 9 months. And it seems very obvious when you say the words out loud, but that's to focus on what you can do. So you'll have a circle of influence and control, and there'll be some things that are outside of both of those, some things that you can't control but you can influence, and some things that you can influence and control. And focusing on that central point there as to what you can influence and control is all you can do right now. You can't impact the wider business economy or the wider health situation in the country other than doing the bits that you can focus on. So focus on what you can do to help through this, not the negative aspects that are dragging you back down. We can help. We're doing most of our help through free webinars, information. We want to try and reach as many people as possible to generally help businesses. That's why we're doing stuff like this. Everyone's on this call will get access to the scripts and the guides that we've got, so download those, have a little look around with those. Like we said, if you haven't already, then we do strongly recommend you get in touch and ask for a copy of the business continuity plan webinar, and you can go off, and again that has the Word documents and the guides and the templates you need to create your own one. If you really get stuck and you want to help, we can help with that. A lot of work we're doing with businesses at the moment can be around cash flow forecasting. If you're going to apply for CBILS, you absolutely must have a minimum of 12 months cash flow forecast that you can submit. Absolutely no point doing it without that, really up to 3 years. But not just for CBILS, you need to be doing this cash flow forecast anyway. So again, if you want a DIY option, we've got a very basic spreadsheet that you can implement a weekly cash flow forecast over the next 3 months. That's the bare minimum you should be doing. Some of the other things we do with clients is around cash flow management coaching. So we talked a lot about identifying the causes of bad cash flow and coaching you as a business owner to spot these and how to take action as a whole in your business to try and identify these and eliminate the underlying causes, not just here's some reminders to chase your debt, which is important, but catching underlying causes are really key as well. And the other thing that's proved quite useful that we're doing for free for non-clients, if you're a client, you're getting this anyway, but for non-clients is if you are using some cloud software and you're happy to give us access, then we can quickly do a 30-minute health check with you. So, for example, when we're doing things like that, we will be looking at what are your debtor days at the moment? Do you know how long it's taken on average for your clients to pay you? What are some of the quick actions you might be able to take to achieve that? What does your cash flow look like at a very simple level? So if you're interested in that, again, drop me an email and we can help you out with that. So hopefully that was useful to you guys. For anyone that came in late, didn't catch the start, we'll send you the recording as well as the guides that we talked about. So if you do have any questions, I know we covered one off already, then put in the chat or Q&A now, please. And we'll go through some of them. So one question, should your terms of trade be prepared by a legal person or are effective off-the-shelf solutions available? So I'm an accountant, not a lawyer, so carefully caveat this response. Yeah, I suppose, look, obviously in a perfect world, you would go and make sure they're legally watertight. It depends on your business model, your risk profile, your clients and all the rest of it. There are plenty of off-the-shelf solutions. And what I would say is an off-the-shelf solution is far better than no solution. We've taken the approach that we like to try and make ours as open and as understandable as possible. Accountants' terms of engagements can be incredibly long and incredibly technical, and no one ever ends up reading them. So yes, legally you might be protected, but we personally believe in making finance and technical queries and questions easier for you to understand. So part of when we produce our terms of trade is, yes, we have a sort of template which is legally pretty sound. We like to make sure that anyone can read it and actually understand what's going on as well. That's really important for us. So the next question, what would you suggest if people still do not pay? Seems tricky, uncaring to frame with court action in the current climate. However, we all know people will pay those who shout the loudest. Absolutely, absolutely. Remember the empathy. So make sure you've shown the empathy all the way through. Communication is the key here. Trying to reach out and communicate with that client and understanding what their situation is and making a decision, a custom decision based on their situation. So it might be that if someone is generally struggling, so if they are in hospitality or retail, for example, you threatening to sue them or even actually suing them through the court systems is absolutely pointless because they're still not going to be able to pay you. So the only time I would use this right now is if someone is genuinely refusing to communicate with you or being very awkward, or that you strongly believe that they can pay you, they're just choosing not to. And in which case, unfortunately, it might be that a legal option is available. So we haven't really talked about that on the thing today, but the escalation process is generally enough for people to pay if they're going to pay, for the vast majority. So going through and making sure there's some sort of escalation process. So if the email is coming from the member of staff who always works for them, they're probably not going to pay that much attention to it. An escalation process might be that the manager or the owner suddenly emails them, or even better, like we said, it's an outsourced person, so an outsourced credit control function, and that will tend to get people to take notice more. The very worst situation, yeah, obviously the courts are still available to you, but like I said, you do have to use that very sparingly and and I, it's a tricky one. I would still use that route if I genuinely thought someone was choosing not to pay us and they could afford to pay us. Obviously, we are in a very privileged position. We are far better placed than everyone else to be able to make a judgment as to whether that client can afford to pay us or not. So if someone clearly could afford to pay us and just was refusing to engage with us, then that might be an option that's available still as well. But if you do want to go through a particular scenario there, just message me afterwards and I'll give an opinion on that. What are standard late payment penalties? Can they be applied without terms and conditions, or do they have to be listed in T&Cs to be imposed? Slightly more of a legal question than for me, but if you Google it, there are statutory payments and penalties that can be added, and interest rates, etc. So check the rules around the statutory ones. Otherwise, they do need to be listed in your T&Cs. But again, a similar vein to the last question in that having it in there, yeah, I don't really know. I'm not a big believer in that benefiting you too much, because if they get to the point where they need to incur those sort of costs to pay you, are they the right client for you ongoing? Probably not. So that goes back to sort of addressing the underlying inherent issues with your debt collection. Sticking standard late payment penalties on top might get you a one-off payment to come through, but it's probably not resolving the underlying issues that are causing you to have cash flow issues in the first instance. How can HR add value from a strategic financial perspective to a business? So from a financial perspective, we often talk about understanding your core purpose and your core values. So if we take an HR sort of spin on this, and your staff are all well trained and they understand what your core purpose and your core values are, then it can massively help and improve the whole relationship with clients, the credit control process. If your core values and your core purpose is to go out there and help businesses, and your staff or your credit controllers keep that in mind when they're talking to businesses about being paid, that will change the way in which they address this. They're far more likely to show empathy and heart and all the rest of that, if that is an inherent cultural thing that's been built into your business. So HR, like any other aspect, is key here as part of the wider sort of structure of your business. Finance can quite often represent the end game for many people, but actually there's many issues that should be built into the core of the sort of service offering that you're providing. I hope that answered that question. I don't think there are any other questions. Let me just check quickly. I think we've answered them all. If anyone's got any questions, put it in the chat now, and we'll be able to cover that. But it looks like we covered all of those. So before we part, one quick parting thought, which is when you show deep empathy towards others, their defensive energy goes down and their positive energy replaces it. That's when you get more creative in solving problems. So to put it into context, if you adopt a hard approach straight away for credit control, you don't show the empathy, you're likely to face resistance. If you focus on the empathy first and then try and come to a solution with the client, you're far more likely to get paid. So hopefully that helps. Let's make sure we all approach our own cash flow challenges with empathy to get through this difficult time. Lovely. Thanks for listening, guys. We're going to wrap up there. Any questions? You've all got my email address. You can see it on there. Fire any questions over. We're more than happy to help, client or non-client. Thank you.